Since the BlackRock announced their application for an ETF, Bitcoin's dropped from 25,000 to 20, almost 28,000. That makes sense. Oh, about 10%. But that's still hopium. We have to hope to get that ETF. It's probably going to happen now because it's BlackRock. We're all in there, and everybody's thinking that. But if you look at Bitcoin versus the NASDAQ, that ratio, it's like 1.7 or so. It's the same as first traded in 2017. So I'm big picture macro bullish Bitcoin.
In a recent interview with David Lynn, McGlone suggests that the surge in Bitcoin's price following the announcement of BlackRock's exchange-traded fund application is nothing more than hopium. Bitcoin and the NASDAQ index have been exhibiting a notable divergence over the past 2 weeks. While technology stocks continue to climb steadily, Bitcoin, on the other hand, experienced a downward trend. This is a departure from their historical pattern of moving in tandem. McGlone expressed his bullish stance on Bitcoin from a macro perspective, emphasizing that he sees potential in the cryptocurrency. McGlone believes that among crypto assets, Bitcoin carries the least amount of risk. Nonetheless, he believes there is still significant downside risk for Bitcoin due to his perspective on the possibility of a severe recession in the United States. According to McGlone, Bitcoin will eventually emerge from its current state and adopt a trading pattern resembling that of gold and long-term bonds. McGlone predicts a potential correlation where he envisions a scenario of gold experiencing significant price surges, reaching around $3,000, while the S&P 500 index drops to 3,000 points. He argues that the Federal Reserve's ongoing tightening policies suggest the likelihood of one of the most severe recessions in recent memory. As a result, there are two possible outcomes: either the S&P 500 crashes significantly, or gold witnesses a substantial increase, or perhaps both markets converge somewhere in between. McGlone tweeted about a 70% chance of a U.S. recession, drawing parallels to previous economic downturns. He pointed out that in both instances since the year 2000, commodities and stocks only found their bottom after substantial interest rate cuts by the Federal Reserve. He further noted that the current situation resembles that of July 2007. Here are a few glimpses from the discussion that we'd like to show you. Before we proceed, make sure to subscribe to the channel and hit the bell icon for more updates.
If I'm right about risk assets declining in a normal recession, cryptos are the riskiest assets. Bitcoin's the least risky. I think they still have a lot of downside risk based on my view of a serious U.S. recession. At some point, Bitcoin's going to come out of that and trade more like gold and long bonds. Is this the time? Maybe, but it's got to show me more divergent strength. Like today's one day, Nasdaq's down 0.2 and Bitcoin's up 4. That's one day. But overall, you look at Q2, Bitcoin's had a horrible quarter, and Nasdaq's been up. And why? Okay, so we've had we've had the SEC crackdown. Yes, that makes sense, but that shouldn't really hurt Bitcoin. It should really hurt the other cryptos, the other 25,000 that are just fully, way overhyped and speculated. It's just too much, seriously, speculation. I remember I used to see a lot of the trading pits. This makes those look that hype look like sissy stuff. So that to me is, we need to get through that period. But right now there is not that ETF that people are bidding Bitcoin on, and it's the overwhelming macro that I'm concerned about. That if I'm right about markets just doing what they normally do in deflationary recessions, as indicated by the yield curve and commodities, and Fed's still tightening, Bitcoin's still going to have some major pressure factor. So here's the narrative. Gold versus the S&P back over 100 years has been as high as, S&P divided by the gold is basically, the mean is about 1.2. The high's been about 1.3, and it's around the low right now. S&P is like double the price of per ounce of gold. So here's one scenario for the recession I'm looking for. Gold pops to 3,000, S&P drops to 3,000. That's a 1-to-1 ratio. And if you go back 100 years, that ain't much. Needs to be pointed out, you don't earn interest in the gold, you don't have dividends. In the S&P 500, you do that. I'm just pointing out the fact of the ratio of the two assets. The most significant measure of risk assets on the planet is the S&P 500. And it's maybe double the price of gold right now. As we head towards a recession, I think they're going to head towards one, which is not profound. 1-to-1 parallel ratio per ounce of gold, because that's almost always what's happened in recessions, and we haven't even got started, and the Fed's still tightening, which basically implies this is probably going to be one of the worst recessions in our lifetimes. Right now, I look at it, my opening up my potential crystal ball, I think it's more likely gold goes to 3,000, S&P 500 goes to 3,000. Now, that's going to see a lot of iterations, and that's the risks of making predictions. But this is what I see right now, and particularly because there's virtually no one who is bearish the stock market. I mean, they have been by the strategists, and that to me is where you should get good bear markets, is when you have a fundamental underpinnings for a very bad period for equities, if you just follow the rules of liquidity and recessions.
In a recent tweet, McGlone said, the NASDAQ 100 stock index has not witnessed sustained gains above its 200-day moving average to this extent since the internet bubble of 1998 to 99. The increase of over 24% recorded this year until June 16th carries significant implications for the overall market. According to McGlone, if the S&P 500 were to experience a 10% decline, it is likely that the Federal Reserve would have already initiated measures to provide economic stimulus. The key point here is that the absence of such liquidity injections hampers the overall performance of risky assets. Liquidity plays a crucial role in bolstering these assets, and the continued withdrawal of liquidity ultimately affects their bottom line. According to him, it is irrational to anticipate a mild recession given the substantial number of rate hikes following a surge in liquidity. He believes that a reciprocating recession similar to the ones experienced in 2008 to 2009, 2000 to 2002, and possibly the 1980s is highly likely.
Let's look at the last two recessions. You look at the NASDAQ, it bottomed and got down to about 40, dropped on a 52-week basis, about 50%. And from peak to trough, the S&P 500 dropped about 50%. The big difference is at this stage, say if the recession starts in a month or two, the Fed had already started easing. And there's not even price for that yet. So here's the lead and lag. I haven't lived, I'm only 58, I've never seen this. Now, there was a decent tightening cycle in 1994, but it was for good reason, and it worked out fine. This is much different. And it's just taking that liquidity away. So that's my point, is that the market's already, it's broadcast, and that makes sense, but I think people are way underestimating how severe it will be just based on the lessons in the cycles of history. And the bottom line is booms and busts always come on the back of liquidity that dumps, and we've just never had, ever, extremes near the last pump in liquidity that's dumping. So to me, I'm putting the history in there, and also I look at what's happened in history in 1929, 1930. The S&P the Dow dropped 50%. It bounced 50% to the 1930 high. You have to do that in human nature to make people feel good about a false narrative. And then the rest is history. It did similar in 2007. The NASDAQ bumped up to similar. It is now almost a third, 30% or so on a 52-week basis, and then rolled over. So to me, this is what the setup is. Let's put it this way: if the S&P 500 was down 10% in the year, the Fed probably would have started easing already. That's the point: is we're not getting that liquidity to pump. The bottom line for all risk assets is the liquidity that helps boost them, and the liquidity still be taken away. That's the bottom line. I think it's illogical to expect just a mild recession after the greatest amount of rate hikes ever on the back of what caused those rate hikes, the biggest pump in liquidity that's dumping. So I fully expect just a reciprocal recession, just like we had in 08 and 09, like we had in 2000 to 2002, that area, and maybe in the 80s, which means a pretty normal drawdown in the S&P 500 peak to trough is 50%. It's done that twice in the last decade, and since the beginning of the millennium. So to me, that's what I think we should expect. And also the bottom line is, David, the market completely is not priced for that. So as a strategist and a money manager, market's already priced for the stock market to go up a lot. It already has. If you look at the NASDAQ relative to its 200-day moving average, it's about 25% above that level. It hasn't sustained that high on a short-term basis, 200-day moving average, since the stock bond, the internet bubble.
McGlone reached the conclusion that the present financial landscape signifies the potential for one of the most significant corrections in our lifetime. He draws a parallel to the period of 1929 to 1930, highlighting the similarity of everything tilting lower in both cases. What's your stance on McGlone perspective? We encourage you to share your views in the comments section. If you found this content informative, please give it a big thumbs up and subscribe to our channel for the most up-to-date news and videos. Thanks for joining us.